Okay. All right, thanks. Well, thanks for coming, and thanks for looking in, if anybody is. That's kind of weird, but I'm going to be presenting some research on an experiment that considers R&D incentives in emissions trading markets, okay? And I'll get into that in some detail in a bit. I was told that we may have some non-economists here, but I think mostly we're economists, so I think I'm going to skip over, because I presume there are thousands of people streaming online that need that need the introduction to emissions trading markets. But you know, real quickly, these are just one of many different types of incentive regulations that we have as alternatives to command and control regulation. The basic idea being that we're creating property rights and allowing firms, or in some cases individuals, to trade those rights to emit pollutants of various kinds. And if the market works properly, then we'll have trading equate the marginal abatement costs across firms. Now, there's different ways, and this is one of the things that we're looking at in our experiments, different ways that we can allocate these permits initially to polluters, okay? They can be grandfathered, that it was given to existing polluters, and maybe in some relationship to their pollution rates or production capacity, or they can be auctioned off, or some combination. Some are grandfathered and some are auctioned. Different emissions trading schemes in practice have used all of these different methods. Oftentimes politically, by the way, these schemes get rolled out as grandfathered because it's a lot easier to tell an industry, we're going to regulate you, and by the way, we're going to give you something that's worth billions of dollars in the process, and they're much more likely to politically support it in that case. But then, for example, in the European Union emissions trading scheme, it began as a fully grandfathered scheme and is evolving to fully auctioned over time as a way to wean them off these billions of dollars of assets that they're providing and generate some income for the government as well. So anyway, that's the basic idea. We're going to allocate these permits in some way and allow for trading, and that'll equate marginal abatement costs. So I'll skip over the standard explanation for how this equates marginal abatement costs across firms, since I'm going to presume that people are relatively familiar with this method. And also mention that although this talk is not about emissions taxes, it's another way of implementing potentially the same thing. An emissions permit market is a quantity instrument that allows price to adjust, and an emissions tax is a price instrument that allows quantity to adjust. So if you're more certain about the quantity of emissions that you want to limit, then a permit market might be more effective. But if you want to set sort of a cap on the potential cost to industry per unit of pollution, then an emissions tax works. If the regulator has a lot of information, these are essentially equivalent instruments. But there's different political and practical regulatory issues that affect whether one is used instead of the other. Okay. Now, in practice, there are many different emissions trading schemes. They've been used for a variety of pollutants, including greenhouse gases, sulfur dioxide emissions, and oxide emissions. A lot of people have forgotten this, but some of you who are my age remember that we used to have leaded gasoline. You had leaded or unleaded. I'm looking at you guys don't know what I'm talking about, but it's all unleaded now. But we phased out of leaded gasoline, which of course was used to refine gasoline, a less expensive way to do it. But actually tradable permits were used to phase out lead. Different refineries traded the right to use lead. And these methods work best when they are, we're talking about uniformly mixed pollutants that either geographically or temporally mixed and have highly heterogeneous abatement costs. So you think about something like greenhouse gas emissions, which is kind of the key example I'll be using here through the talk. It's a globally mixed pollutant, doesn't matter where the emissions come from, and it's also a stock pollutant, not a flow pollutant. The emissions are going into the atmosphere, it doesn't matter really when they occur, because the lifetime of these greenhouse gas emissions is well beyond our time scales. So That's one reason why emissions permit trading is particularly well suited for greenhouse gas emissions. And also, heterogeneous abatement costs, I skipped over my example, but you have the greatest gains when you have very large differences between the marginal abatement costs across polluters. If everybody's the same, there's no gains from trade. And so if you can include more different types of sources, like through international trading, then with different levels of economic development, then there are largest potential gains from trade. Now, I'll mention, by the way, that just as an aside, this is not a talk about politics by any means, but of course, this whole notion of emissions trading, or cap and trade, that's been demonized by Republicans, is a truly and clearly Republican idea. It was championed and pushed through by the first Bush administration in the Clean Air Act amendments of 1990 over the objections of most environmentalists. And now everything is completely flipped, where environmentalists are pushing for the use of these types of methods to control things like greenhouse gas emissions. Some greenhouse gas emissions in practice include the European Emissions Trading Scheme, and the numbers here reflect the year that permits were tradable and enforced. The Regional Greenhouse Gas Initiative, which is in the northeastern U.S., has been around for quite a few years now. This is basically mid-Atlantic and New England states. And California, more recently, has had an emissions trading scheme that is growing. And this talk is more about, broadly speaking, the notion of allocation methods and research and development for these schemes. Not about Alaska, but Alaska is involved as well, besides the fact that for the greenhouse gas application, of course, climate change is happening approximately twice as quickly here as in non-cold regions. But also, Alaska is involved in the California market, for example, through negotiations to sell carbon sinks to California entities that are trying to comply. So you can reduce your emissions, or you can pay someone else to reduce emissions or sink carbon as well by not cutting down forests, for example, which is a recent negotiation going on in Southeast Alaska. We also have carbon tax programs. I mentioned they're very similar as well in principle to emissions trading. It's ones that have been going on for quite a while in BC. Washington State patterned one right off of BC's scheme, which failed in last month's election, unfortunately. I'm not sure why. I haven't read explanations for that. But a quick snapshot of what's been going on in BC. This is a time series leading up to the implementation of the BC emissions tax. And there seems to be a divergence in the petroleum product usage in BC relative to the rest of Canada following the emissions tax being implemented. So it seems to have worked, and yet Washington decided not to implement it. In any case, theoretically, it should work because it's putting a price on something that is otherwise being emitted without the emitter paying the environmental consequences. All right, so that's the broad introduction, and let me tell you about some of my research on this topic that has employed economics experiments to study an aspect of dynamic efficiency that can arise in these markets. Okay? And as I mentioned earlier, we'll be looking at how that interacts with how the permits are allocated, which is something we can manipulate in our experiments. All right, so obviously from that little introduction, just a few examples of how these are becoming more important in the toolkit of environmental regulators. Most of the research within the area of experiments, but also theoretically, is focused on static efficiency questions. That is, are they able to achieve cost-effective compliance with a given abatement target? And maybe that target is changing over time. So a lot of these schemes will be implemented, and that's a nice thing about an emissions trading program. Rather than changing a carbon tax over time to tighten down the emissions, you just reduce the number of permits that get allocated. That's, for example, how things are being done in the European Emissions Trading Scheme. But on the side, and what hasn't been looked at nearly as much, is how the permit markets also, well, they do create incentives to reduce emissions. So if you have an alternative, you have to pay to buy permits, or as an alternative, you can find a cheaper way to reduce your own emissions, you have an incentive to do that. That's a key way that these incentive-based schemes differ from a command and control system where you have to implement a particular technology that the regulator is asking you to do. Okay? So you can gain profits by innovation. So that's what we're focusing on here. The incentives to reduce your compliance cost or abatement costs over time to improve your profitability. Okay? And in particular, we'll be looking at technological innovation in this case. So one of the aspects we're going to be looking at here, we actually have a model where the allocation method shouldn't matter, but it might matter due to imperfections in the competitiveness of permit markets or biases in our decision makers' ability to understand the difference between opportunity costs and explicit costs. So that's why we're going to be looking at how the investments vary or may vary depending on how firms receive their permits. So this interaction here, motivated partly because in policy circles, there are cases where we're transitioning to auction permits, and then I have other schemes that have always fully auctioned permits, like the regional greenhouse gas incentive market. And in an experiment, of course, rather than in policy, if policy decisions are clearly endogenous, we can exogenously manipulate these policy changes and then evaluate the implications. The main highlight, in case you fall asleep in the next 20 minutes or miss the main point here, is that we do find that there are stronger investment incentives, greater investments, and therefore higher dynamic efficiency when the permits are auctioned rather than grandfathered. Okay? And I'll get back into this, but an intuition for that is that when the permits are being auctioned, everyone is having to buy the permits rather than the case with the grandfather where we have some permit sellers. And because everyone is buying the permits, everyone benefits from lower permit prices that arise through successful research and development. And just before I get into the details, let me highlight this quote that I like. What we are focusing on here is an aspect of looking at how the policy instruments affect technological innovation. And as this quote from Nies and Schultz highlighted from many years ago, the extent to which the instruments spur efficient investments is one of the best ways to evaluate whether the policy is good or not. And that's one of the key things that these sorts of incentive-based instruments are effective at improving. Okay, so just a couple slides on the literature, a couple slides on the model, and then let me tell you about the experiment, which is the fun part, in my view. There have been people that have looked at this question of how the R&D incentives vary for emissions trading markets. The one aspect that is that an innovator, so you think about innovating to reduce your marginal abatement costs, leads to a benefit, obviously, to the innovator. When the permit's being grandfathered, the industry is lowering the value of the permits, essentially, because the permits are determined by where the aggregate marginal abatement cost schedule intersects the supply of available permits. And therefore, by reducing the value of the permits that they're endowed with through the grandfathering, there are less rents that they're able to extract in that case, and therefore have a reduced incentive to innovate. Montero highlighted, and that's actually true in our model as well, when we have perfectly competitive markets and full understanding of the opportunity cost of permits, the R&D incentives should be independent of how the permits are allocated, but he formalizes through a model of imperfectly competitive permits why this can lead to reduced incentives for well, greater incentives with for R&D when the permits are being auctioned.
Tim,
Yeah.
in that case, for that paper, what defines or what generates the imperfectness of the competition? Is it incomplete information, or?
No, it was market power, sort of a small industry size where firms could exercise power over the permits themselves. So that would make most sense if you had, say, a situation in a country with a large state-owned electricity generator or something like that, where there's considerable concentration.
Okay.
With small regional water markets.
Sure, yeah. So I've looked at some emissions trading schemes for water pollution with one, this is actually calibrated for Port Phillip Bay in Melbourne, Australia, where the municipal sewer company had 70% of all the emissions that were being regulated. So you can have situations where there's quite a bit of concentration. I'll skip over this other than to highlight a few more recent things looking at, these are not looking at R&D, but they're looking at technology adoption. If there's new available technologies that need to require investment to be adopted, and they can have the auctioning or grandfathering mechanism can affect them as well. All right, so just two slides, one on notation and one summarizing the standard results here that come out of it. We have a setup where there's a permit price that's determined by the market and abatement choices by individual firms, and a level of R&D which is going to affect, that incurs a cost, but it's going to affect the change in marginal abatement costs. So this just highlights, in our experiment, the way we're implementing this is there's a particular marginal abatement cost schedule that is shifted down by some simple delta if R&D is successful. Okay, we could have done it, there's lots of different ways one can model R&D. It's a stochastic process. We wanted to incorporate that into our experiment, but is it a new technology that provides for proportional reduction in abatement costs, or what? We did a simple situation where it just was a parallel shift down in the abatement costs. And I'll show you a numerical example as we employ it in our experiment in a few minutes. But that's the way we're thinking about specifying research and development here. It's just a change in marginal abatement cost at some cost.
Tim, just
yeah.
really quickly, with abatement costs, I mean, so you're characterizing it as research and development, but another way, and I'm wondering if these are consistent ways of thinking about it, is you can have a multi-input production process with some inputs cleaner and some inputs, I guess, dirtier, and then the now price on pollution creates an internal kind of firm restructuring of how they use their inputs. And so I'm wondering if the marginal abatement cost in that way would also be consistent with the way of thinking about it through R&D investment.
Yeah, so I think what you're describing sounds like technology adoption, where there's a clean technology and a dirty technology out there, right? And certainly these incentive regulations like this, make that the critical choice for environmental compliance, right? And clearly there are incentives created to adopt cleaner technologies. What I have in mind here is, rather than adopting existing technology, I can think about incurring costs to lower my, to come up with something new, okay? And others are doing the same thing. So we want to get at, if there's some uncertainty, rather than just adopting a technology at some cost, you incur a cost and you may be able to reduce your pollution or not. Reduce your abatement cost, that is, which is making it cheaper to reduce your pollution level. So setting this all up into the expected profit problem here, expected utility, but then we'll just assume risk neutrality. We have the standard first order conditions, basically the expected permit price equals the expected marginal abatement cost. That's how we get everybody's marginal abatement cost, the expected marginal abatement cost equated across firms, but also the expected marginal reduction in the abatement cost equals the expected marginal R&D cost. So there's nothing unusual here, but I put the slide up simply to highlight that the permit allocation, which I talked about a few minutes ago, is something that we're going to be looking at. It actually plays no role here. And it plays no role as long as everyone's price takers and the permit price P is given by the market. In other words, markets are perfectly competitive, which is a critical assumption, which may or may not occur in emissions trading markets in practice. And also, the opportunity cost of holding a permit that's been given to you for free is the same as the cost of explicitly having to pay for it in an auction. Right? So if you understand the difference between opportunity costs and real explicit costs, this is why there is no role here for the allocation method. But we also know from other experiments and study of firm behavior that opportunity costs are sometimes accounted for. And we may do this in our everyday lives as well. It's certainly something that our students have trouble learning sometimes, this idea of that opportunity costs are the same as real costs. So it's certainly possible that grandfathered or auction permits may be treated differently because one represents an opportunity, one represents a real cost. Yeah?
Is there a public goods aspect to this where if I invest and come up with some way to reduce my abatement cost, can I keep that private, or do other people also?
So we're not modeling the spillovers. So that's an important aspect of R&D that we have lots of different theoretical models of R&D being underprovided in equilibrium because of the public good aspect and technological spillovers. We didn't include that at all in our model or our experiment, but that's certainly important. And I'm going to highlight that we get more. Not only do we get more R&D under auctioning than grandfathering, as I mentioned earlier, we also get more R&D than the non-cooperative Nash equilibrium level of R&D, which is a good thing if there are spillovers, which are kind of on the side here. So we know that we believe from all these models and analysis of R&D that it's underprovided in the market because of the public good aspect of it. So the over-provision that we observe is probably a good thing. All right, so segueing now into how to set this up in an experiment, what we do is we bring our subjects into the lab and assign them marginal abatement cost schedules, randomly assigned to high and low cost abatement firms. The subjects are going to be making the decisions as the firms, and they have an operating budget, and they are trained that they can earn more money, and they can walk out of the experiment with considerably more cash if they do some trading that allows them to lower their cost of meeting the environmental objectives that we've provided. We can aggregate the schedule of marginal abatement costs. These are the actual schedule that we used in the pre-trading. So these are just, this abatement cost schedule just represents the cost that one has to incur to reduce pollution. We have 48 total permits that are allocated to the market. Okay, that's the cap on the pollution. And it makes sense to avoid the higher cost abatement and pay for the permits when the prices when the abatement costs are below. You pay for these abatement costs and then you buy permits for the others. So the equilibrium price is well defined here, where the supply and demand of permits essentially intersects. Okay, in this case, between 135 and 138 experimental dollars. Okay. Now, we want to study these R&D incentives. We want to study the dynamic efficiency in this market. So we need more than one period. Okay. But the trick about an experiment, the trick in designing an experiment, is always to make it complicated enough to capture the key thing that you want to get at that's novel in the experiment, but keep it simple enough for to not confuse the subjects. Okay, so we need more than one period of trading, but we don't want there to be opportunities for learning and other aspects. So we go to the first number above 1, which is 2, period. So that's our dynamics. We're going to do a 2-period cycle repeatedly to allow for some learning, but also to be able to study the investment process. So the way this works is we're going to allocate some permits in some way and allow for our traders to reconcile their permit holdings based on their realized abatement cost. Then they'll make an investment decision where the investment is in how much to undertake R&D costs to try to lower their abatement, and then they learn whether they were successful or not. Let me show this in terms of a timeline. Okay, so within a single period, we're going to repeat this cycle over and over again. Okay, so first of all, we give away the initial permits. That's on the far left there. Double auction trading, that just refers to the reconciliation market trading rules. It's a centralized method of trading that's been used in experiments since the late 1950s, when Vernon Smith was first doing his experiments at Purdue University, by the way, my home university. I had to throw that in. But it basically is a way of capturing an order flow through a centralized market that approximates trading on securities markets, where bidders can, in continuous time, put in bids to buy or accept sellers' offers to sell. Sellers can put in offers or asks to sell or accept bids to buy buyers. And everybody can do that, but all the information is centralized. This is a computerized version of doing this. So they do some trading and realize what happens. Then we reallocate some permits and allow them, here's the twist, what's introduced in stage 2 is this R&D investment. It's the only difference between stage 1 and stage 2. Okay? But of course, because of the R&D investment, the trading over here is going to be different, because some of the R&D will be successful, and that's going to lower the equilibrium permit prices. Okay? And then people collect their cash. You know, they actually collect it all at the end, and it accrues into their trading account at the end of the period. Okay? The R&D investment stage, which is the novel aspect of our experiment, is this cost that they incur that increases the probability that they're going to shift down their marginal abatement cost schedule by a fixed constant. That was the delta I had on the slide a few minutes ago. So you're either successful or you're not. It's a binary outcome of the R&D process, but your likelihood of success is this concave function. So you can't assure yourself of being successful. Your initial investments are useful, but they're limited. So not everybody's going to succeed, although in some periods, especially if they're over-investing in R&D, a number of them are going to be successful. Subjects will learn privately whether they were successful or not, and then they do some more trading. Okay? And because of, so we bounce back here. Here was our original marginal abatement cost schedule. This is going to be shifted downward to some degree at different amounts in different periods, which is what's leading to lower permit prices. Okay? So as innovation occurs, this is going to put downward pressure on emission permit prices. Now, we're going to keep our supplier permits fixed, but in practice, of course, permit markets ratchet down the available permits in order to reduce over time the emissions that are going out.
Tim, sorry, I'm missing the why is there another permit allocation after the first round of auctioning?
So we're trying to represent 2016 and 2017. Two different, we've got just before and after R&D.
No, sorry, if you go even before the R&D decision, maybe I'm just misinterpreting this. There's the stage 1 where you've got initial permit allocation and then a new permit allocation. Is that new permit allocation just based off of the results of the double auction trading? Or
no, it's going to be, so think of this as so every year, actually in California, every quarter, but there's a time period. So in California, every quarter, there's a new auction of permits. Okay? And there's some compliance period where if you have emissions, I don't know what it is for California, but If your emissions are in 2016, you have to have a permit that's valid in 2016 that you then turn in to cover your emissions. So you have to have these allocations periodically.
Okay.
To inject new permits, because these permits are, it's not an indefinite permit to emit, it's assigned an amount of pollution and over a certain time period.
Oh, I see.
Right?
Okay.
So this is like, think of this as January 2016, stuff goes on, no innovation took place. This is January 2017, we're going to look at the implications of the innovation.
Okay, yeah.
Okay?
I get it.
Good.
Tim, does
Yeah.
each player just have one segment of that abatement cost?
Yeah, yeah. So that was the aggregate one I showed you, but we have in our sessions we have 8 traders. So 4 of them happen to have the high abatement cost schedule, 4 have an identical low abatement cost schedule. In aggregate, they account for the thing I showed you. So that's why things are going to be shifting around different amounts. Okay. In the experiment, we've got 20 markets of this type. They're divided into 10 markets with fully grandfathered permits, where we just give them away and allow for trading, and 10 markets where we fully auction them. We've got obviously done things in between as well, but our treatment variable here is just fully auctioned or fully non-auctioned. And as I mentioned, where these they occur before the double auction reconciliation trading, but also before the R&D choice as well. For the auction itself, we had to make a decision on how we're going to auction off the permits. We use a uniform price auction, which is similar to the European emissions trading scheme. Basically, everybody puts in a sealed offer schedule saying, well, this is how much I pay for one permit, this is how much I pay for a second permit, and so forth. Those get aggregated together along with the available permit supply, and everybody pays the market clearing price. Okay? That's distinct from pay-as-you-bid auction, which sometimes occurs for treasury auctions, for example. But it's fairly transparent. And then we can look at what the clearing price is over time. All right. So here's just a couple screens from the experiment, just so you can get a sense of what the subjects are doing. I haven't populated with, this gets filled with lots of numbers during trading. The subjects see, oh, this reminds me to mention that one thing that we featured in our experiment is neutral terminology, which is done in a lot of these types of experiments. Obviously, this is about a topic that potentially has environmental implications. Some of our subjects, which by the way are undergraduate students at Purdue University in this case, the most studied animal in the world, right, is the undergraduate student subject. They may care about the environment, some may not care about the environment or be hostile towards the environment. I don't want to bring in those complications. So they're told that, look, you have these production costs. You have a production target you have to meet, but you can avoid some of these production costs by buying coupons, we tell them, that's the emissions permit market and allows them to avoid these high costs. So that creates the incentive to pay lower coupon prices to avoid these 135, 155 permit cases. And then this is how I put in my offers to sell or offers to buy. Anybody can be on either side of the market. And then when trades occur when someone puts in a buy offer that is above a sell offer, and immediately a trade occurs at that sell offer. Or you can just hit the buy buttons right here as well. Anyway, so trades occur. Here's how they submit their offer schedule. They can buy up to 10 different permits. They have to fill out, how much would you pay for first, second, third, fourth, and so forth. This is how we auction them in the auction treatment. In the grandfather treatment, they just get the permits for free. We skip this step. And then lastly, here's the R&D screen, where here's the current production cost for an individual for their 10 units of abatement, this is the marginal abatement cost schedule before R&D. And if they're able to lower their production costs, that's the R&D, then these have shifted down by 50. Our delta is 50 here. So again, it's pretty simple. It's a way of incurring some costs. Here's the amount you invest, and here's your chance of lowering your costs and getting to shift. Now, how are you going to learn the implications of or benefits of lowering your costs. It's going to do several things. It's going to lower the equilibrium price of permits, so overall prices might be lower, but if you have lower costs, then you save some money that way, and you can sell some permits as well. This takes some learning, so that's why we take this cycle, which I've described, and hopefully you're clear on what we're doing, and we do it over and over again. This is called stationary repetition in economics experiments. It's not always done. For a really simple experiment, it's probably not necessary, but for one where you have to make decisions that you realize the implications of those decisions through market trading, it may take a while for you to learn why you should do what you should do to make more money. So essentially, we're trying to create incentives for our subjects to make money by their activities here in research and development and trading permits, but to learn what's a sensible thing for them to do, they're going to have to get some experience.
How are they
Yeah.
making money?
So-
Not through the permit market, but in the product market?
Yeah, so what they're doing is they're getting some revenues, and they have to they're getting fixed revenues every round, but they have to incur production costs to make those sales. So there's this sort of on the off stage, there's this production market, but what we're focusing on is their emissions trading scheme, the side of it, which is how they're avoiding some of these production costs by buying more coupons. So for example, here you can see this person's status, their experimental dollar cash is right here. That's what gets translated into US dollars at the end of the experiment. Because he has 6 coupons, he has to produce 4. If he sells a coupon, then he has to incur this cost to produce the 5th unit. And so it's kind of weird when we're describing to the subjects, but they get it eventually. It's the idea of avoiding, and of course in our case it's avoiding the emissions abatement costs by buying permits.
So the grandfathered permits are distributed randomly, independent of?
They're not random. We just give a certain number of permits to each subject.
Okay.
And that raises a good question. So, the allocation method is sort of a political decision rather than an economic decision, because if the market works competitively and efficiently, it doesn't matter how you gave the permits away. All that determines is the rents that you're allocating. But clearly there are some gains that some will have compared to others. When you give them away, if it's somewhat random, which is, I guess, the way you can say the way we did it, then you got to do a lot of trading to find the right equalized marginal abatement costs across firms. So there will be more trading for that purpose compared to auctioning, where in the auction, the people who should buy in the auctions are the ones with the highest abatement costs. So you should have less trading in this reconciliation double auction market, and that's what we see.
If that first auction works perfectly, should you see any trading in the second auction?
You should see no trading.
Right.
The reconciliation market should be irrelevant under situations of no uncertainty.
Right.
Okay? So in the case right here, stage 1, we should absolutely see no trading at all here. Okay? In stage 2, we will see trading because this is stochastic.
Right.
So the people who are successful innovating, they found, well, I don't need all these permits, so I can sell some. So, but it should still be less than in the grandfathered case.
And so just one more question. The grandfathering that you get in that first initial permit allocation is the same as the new permit
Yeah.
allocation? Okay.
Yep. All right, I think we're ready for some results. Hypotheses and then some results. All right, so to summarize, as I mentioned, R&D investment actually shouldn't depend on the allocation method if the markets are perfectly competitive and opportunity costs are fully understood. The amount they should invest is 30, given our numerical choice of parameters in the experiment. We have specific predictions on what the prices should be, and they should be lower in stage 2. In the allocation auction, we should have the high abatement types buying more and much lower reconciliation. That double auction market trading volume should be lower in the auctioning case than the grandfathering case because of the closer allocation. Numerically, it looks like this, but I'm going to come back to this because I'll add to this table the actual average behavior in a moment. All right, so just to give you a quick overview of what the data look like for an individual session. This is a time series. This is actually the seconds in the period, I believe, as we're going along here. Stage 2, remember, is before R&D. And stage 1 is before R&D, stage 2 is after R&D. Here, in stage 1, at the beginning of each cycle, we have a range of 135 to 138. So that's why it's always the same in stage 1. Stage 2 is lower. It's always lower, but how much lower depends on whether people were successful or not. So these are just predictions based on realized R&D success. And I'm going to add to it now the actual trading prices in this particular session, which is 1 out of our 20 sessions. This is just a little bit of data to orient you. Okay? And, well, that's a mess, right? It's certainly a mess initially. Prices are all over the place because people don't understand initially how to make money in the trading market and how the competitive forces are pushing prices towards equilibrium levels. These types of markets have been studied a lot in cases where we have a constant competitive equilibrium price, and they do converge. That's very well known. And we're getting things that are looking more like convergence in the later part of the periods. Now, you have to kind of eyeball it a little bit more and let your willing eye see this, but you see, for example, things like in these later rounds, the dots, these are the individual transaction price levels, tend to be higher during stage 1 and lower during stage 2. Higher, lower, higher, lower. You see the pattern, that shifting pattern is occurring. There's still obviously variability, price variability, that these individuals are choosing the prices they're going to trade at. But you wouldn't say that markets are perfectly competitive and everyone's a price taker here, though, either, right? Because no one's a price taker. Everyone's a price taker and a price maker, right? So this is capturing some aspect. This price volatility reflects imperfectly competitive markets in a particular way, which could affect the results.
What's going on at 2400? Is that?
This is just this is the legend. Here's one price. That price? Oh, this. This was just a really lucky period where lots of people succeeded in their R&D. And therefore, the prediction was the prices should be much, much lower. Prices do move in that direction, but clearly don't get down as far as they should.
There's no dependence between these cycles.
No. Each cycle starts anew, and that was by design.
Yeah.
Here's a similar figure I'm going to show you now for an auctioning session. So this was, we're just looking at was for grandfathering. Quite a few dots because there has to be a lot of trading to reallocate these permits. And again, this is again another new stochastic series depending on the R&D investment. But notice there's a lot less trading required in the cases of auctioning, okay? Because the permits are already tending to be held by the high abatement cost folks. And again, you see the pattern. The pattern actually starts to emerge even earlier in the auctioning case where this high, low, high, low, high, low pattern. Okay, so they're not getting it perfectly, but they're catching on clearly with some learning. Okay. Now let's look at the overall. I'm going to just highlight some of the key results, starting with the R&D investment. The R&D is supposed to be on 30. That's the equilibrium level of investment. That's the symmetric, but only Nash equilibrium of this situation, where everyone should invest 30. Obviously, there's more investment on average. We look at the frequency distribution here. But also notice that the auctioning treatment tends to have the higher weight for the higher investment levels than the grandfathering treatment. Okay? And in fact, this is significantly different. Here's another way of looking at the exact same thing. The auctioning treatment first order stochastically dominates the grandfathering treatment in terms of the overall investment, but with a lot of variation when the point prediction of the equilibrium is just on 30. Yeah?
How do they change over time, though?
Don't think I have a slide for that. They don't change substantially over time. That's a good question, but it wasn't, I forgot now, but it wasn't interesting enough to include. We have some other things to look at, investment, or prices over time. And also, 83 or 73%, depending on the treatment, is over-investment relative to 30. Okay, and that gets back to your question, Andrew, about the spillovers, right? So we're seeing overinvestment, about, even though it's not part of our setup here, it is something that we're glad to see, given the public good nature of the
But it's
potential
private.
spillovers. It is private
I
here.
don't know if you succeeded and I can't use your
Right.
success to my advantage.
That's right.
So if I had that option, that you might.
Then we might see, well, we'd have a different prediction
Yeah.
for the equilibrium level of R&D. Yep. All right, so this is the first row we were just talking about. Equilibrium prediction was 30. Here are the means and standard errors. Here's the stage 1 auction allocation. Prices are a little too low. I'm going to show you some time series for these. So let me come back to these. Avoiding tables of numbers, replacing it with pictures is usually a good thing. So this is over time. This is our 135 to 138 prediction. Those are the flat black lines. In stage 1, we tend to see prices a little bit too low, but not dramatically too low on average. But in the A treatment, that's the red line here, they are significantly lower. But they're not significantly different across. They're not significantly different across the two treatments. Okay. The auction. So we look at the half of the data where we're not grandfathering the permits but auctioning them off. In stage 1, we should see prices that are in this level for in stage 1, which is the blue line, and they're too low. Okay. They're significantly below the equilibrium prediction. The cases for stage 2, that's comparing the red data to the red prediction. There's no significant difference there. There should be 118 in both cases. This is based on the expected level of R&D that would lead to lower prices. In stage 2, the predicted price depends on the level of R&D, and prices are generally in the blue line here, the grandfathering treatment, not significantly different from the equilibrium, but in the red treatment they are. And we should see lower prices in stage 2 because of the R&D, and we do see that. Okay? So in other words, to summarize, we see more R&D investment in auctioning rather than grandfathering. We see prices that aren't significantly different during stage 1 here. Prices do decrease when we move to stage 2. And here's trading volume, which I haven't shown you with figures, but because the permits are correctly allocated, or more correctly allocated through the auction, we see a lot less trading volume. Per subject, it's about 1/2 of one permit is traded each round rather than more than 3, which is close to the level expected under grandfathering. All right, so I'm ready to wrap up here and take more questions if you have them. To summarize, first the dynamic efficiency aspect of our study, which is, I guess, the most novel feature here, is we do see overall higher levels of R&D and greater dynamic efficiency with auctioning rather than grandfathering. Now think about this intuitively. When the permits are being auctioned, everybody's a buyer at the start of the round. Okay, and then because of that, everyone can benefit from lower permit prices if they have to acquire them explicitly. Okay. On the other hand, when permits are being grandfathered, we've got some subjects, half of them, the way things were set up here, half of the subjects are going to be net sellers of permits, given the pattern in which they were grandfathered. Now that's an opportunity cost that should be treated the same as the explicit cost they have to incur in the auction, but if they fail to interpret it that way, they're going to think, well, the downside of having lower permit prices, which occur when R&D is successful, that lowers the price that I can get and the profit that I can get from the permit market. So there's lower incentive to undertake R&D in that case. They suffer from that lower permit price. Okay? That seems to be enough to drive a statistically significant difference between the auctioning and grandfathering R&D incentives. We do see some differences in the average permit prices. They tend to be a little bit too low before investment and a little bit too high after investment, but they certainly are different in the two phases as predicted through the R&D process. And we do see lower market liquidity or less trading volume when permits are being auctioned, which is a good thing if you want to avoid transaction costs as well. One thing that we are taking, I'm collaborating with Franz on a new project, along with John Strandland, who many of you know as a longtime co-author of Jim's. We're going to be looking at price controls in this environment with R&D. We have a nice model of how price floors can encourage R&D and price ceilings can discourage R&D. So you think about an environment with uncertainty about the overall fluctuation in permit prices. Permit prices can vary for a lot of reasons besides R&D. In the case of greenhouse gas emissions, permit prices can be sensitive to, well, changes in climate, but also changes in weather, right? If it's a particularly warm summer in California, that's going to increase permit prices in California because the electric demand is a lot higher, okay? In situations like that, due to those kind of fluctuations, price floors put some safety net on R&D returns because prices crash to really low levels, you can't benefit from R&D. So we're relating this to the R&D incentives, and ceilings have the opposite effect. You can't exploit benefits from R&D if we put limits. So we're going to look at these types of collars, in part because, well, again, R&D is really important, and understanding how R&D is affected by emissions trading is the central issue of this research agenda. But also in practice, in California, in the European Union ETS, in the RGGI scheme, they all have different versions of price controls that are either being implemented now or under consideration. We want to understand the benefits and costs of doing that within the context of an emissions trading setup. Yeah?
So it seems to me that there's no, is it correct that there's no auctioning or grandfathering again after the R&D choice? You just go to a double auction from there?
So in our setup, yes, right? In practice, so we're just trying to capture a snapshot of what is really, a more interest, what we care about is how things happen over 80 years or something.
Of
right?
course. I guess I'm just trying to think of if the mechanism that you're trying to describe is, for the results that you see is due to this opportunity cost versus actual cost, wouldn't you need to have another grandfathering or initial auctioning off again after the R&D investment? I mean, if you know that you're not going to get that grandfathered again after the R&D, or you have to do another auction again, I guess, with the initial auctioning, does that, I mean, I feel like that's necessary in order to be consistent with the story that you're telling, unless there's some sort of process in the double auction where you get the same sort of mechanism.
I'm not sure what you're getting at in the question, but let me acknowledge that by putting this particular structure on the timing, we are clearly making some simplifications here, right? So we're having a simultaneous R&D choice when in practice firms are at endogenous and continuous time frames deciding on their investments in reducing abatement costs, right? Before and after permits are being allocated, right? So we're definitely simplifying things. I guess what I don't get about your question is what fundamentally we're missing by not having an additional allocation after the R&D. We're letting people reallocate who has the permits. That's what the reconciliation market is for. And that's where we left it, and then we just start over again to study with some learning how the R&D incentives are.
But it seems like you view the permit, potential permit transaction as an opportunity cost if there's under the grandfathering versus an explicit cost under the auctioning, right?
Mm-hmm.
So if you've already made that decision prior to the R&D investment, I guess I don't fully understand why you should change your perception of opportunity cost versus explicit cost. Does that make sense? Unless there's like some forward-looking, even that I don't know.
Yeah, I don't know, because it's not the right way to think about it, right? It's not how we as economists are trained to think about the equivalence between opportunity cost and explicit cost. I don't know what our subjects are doing, but I do think that's relevant to how, I think any behavioral biases that our subjects have are not going to be exactly the same as a environmental manager or R&D team at a firm is going to make, but they may have some similar bias that moves them away from a unbiased understanding of the equivalence of opportunity costs. But I don't really know what it is, so I don't have a good answer other than I hope we're not including something which is, I think, important to that result that is completely irrelevant for the field. It's certainly, I don't have any problem of using, I guess that's not what you're asking, but I don't have any problem using student subjects as decision makers in the experiment, because there's nothing in any models people have put forth about these schemes that say that you need to have 15 years of experience in industry to be a decision maker in the model. It's not how the models work, and we don't have that in economics in our toolkit. But in any case, this is sort of normal for these emissions trading experiments. Yeah.
Did you think about playing around with the grandfathering? I mean, usually the grandfather is correlated with something.
Yeah.
And to see if there's, is this allocation? There's some allocation bias, or if they're behaving rational. This competitive market with the information they have.
Yeah. So we didn't. We actually ended up choosing an allocation of permits that would require some trading in order to be properly reallocate the permits. So we could have given a lot more permits to the people that had the high abatement costs and less permits to the people that had the low abatement costs, and they wouldn't need to trade very much. We did the opposite, actually. We gave more permits to the ones that had the low abatement cost to ensure that there was some good volume in the market. You're right that in practice, there's something that determines it. It's either historical emissions, or in the case of sulfur dioxide, permit trading scheme, it was based on the heat output of your electric utility facility, as opposed to emissions controls you to put on in place. Again, one of the reasons we didn't do that is it really shouldn't matter, right? How they're allocated. It's just a rent allocation rather than something that should affect the performance of the market. We did bias it in a certain way, that would generate a lot of trading volume.
I guess the reason why I'd be interested is, and as you said in the presentation several times, like it shouldn't matter, right? But I'd be curious.
Yeah, maybe it did.
If
right.
it does.
Yeah.
And and then why is that?
Yeah. Yeah. So again, we haven't looked at it, but yeah, I agree that could be interesting.
What knowledge do traders have with respect to their R&D probability of return?
So they know the probability of lowering their production costs or their abatement cost schedule, but they don't know what that will do to the permit prices, which is ultimately where they get that return from. They need to learn that through repeated cycles of our experiment. So it's definitely, they're kind of in the dark initially, and they get more confident to understand how much they can earn by being successful. Because it really depends on how much others, that's why we're looking at the Nash equilibrium in the investment side. It depends on what others are doing in their R&D. Obviously, my returns are going to be greater if other people are not investing, because that way I get to benefit more without lowering the price so much, and so forth. So we know we can calculate what it is theoretically, but the subjects need to gain experience.
In practice, is it usually the case that there's a re-auctioning every year if these are kind of annual kind of volume?
Yeah, they're annual, they're quarterly, depends on the particular market.
It's interesting because so part of me thinks about this in terms of of bycatch allocations
Yeah.
within fisheries, and those are, I mean, I don't know if any sort of auctioning process for those has ever happened, but in the grandfathering, they're grandfathered in perpetuity,
Mhm.
essentially. And there's been a lot of talk about, potential options for not issuing them in perpetuity, but having, 10-year kind of expiration kind of limits on them. And I mean, it seems like in this case with the grandfathering, it in some sense is in perpetuity because they're always getting the same amount every year,
Yeah.
right?
But they're also, so I know the most about the sulfur dioxide scheme because I studied that a lot. This was the one that came out of the 1990 Clean Air Act amendments. That was for sulfur dioxide, not greenhouse gas emissions. But there they were very clear. They grandfathered 97.5% of them annually. But they were very clear to not treat them as property rights because they wanted to avoid the legal hassles of what if they needed to change later on, then there would be a taking issue and a whole other set of litigation issues would arise. So I don't know how it works with fisheries, but whether they're granted in perpetuity, but they're legal property rights or
Sure,
not.
they are revocable.
Yeah.
Yeah.
So that's, again, the lawyers are probably,
Yeah.
involved to ensure they're written in a certain way that
Yeah.
gives flexibility to the regulator.
Does R&D in practice work democratically, or does most R&D in these settings come out of the big players that potentially have the highest likelihood of reducing abatement costs? I mean, does every player realistically have an incentive to engage in R&D?
Well, we have a relatively symmetric setting here where
Yeah.
people differ, our agents differ in their abatement costs, but
Yeah.
not in their size.
Yeah.
In practice, obviously, you have big players and small players, and there's a big IO literature in how the size of a firm affects R&D incentives. Given the fixed costs of a lot of these types of technological investments, I'm sure small players license or capture spillovers from others' innovations rather than innovate on their own. But that's another interesting issue for another experiment.
Yeah,
to look at that
I was
size
wondering,
differences.
Yeah, how size would actually influence engaging in the actual decision, right, to pursue the reduction in abatement.
Yeah. Well, thanks.